Hey guys, welcome back to my channel. Before watching this video, don't forget to like, comment, share and subscribe. Okay guys, I'm gonna read some article in investing.com by Herbert Lass. US yields soared after CPI surprised to upside in August. US Treasury yields surged in a recession warning. The yield curve inversion widened on Tuesday after monthly U.S. consumer prices unexpectedly rose in August, signaling to the market that the Federal Reserve will crack down further on inflation. The yield on two-year Treasury notes, which typically reflects interest rate expectation, spiked to a fresh 14-year high of 3.783% in a move that significantly widened the yield curve gap with the benchmark 10-year Treasury note. Market rates were declining before the consumer price report on expectation headline inflation had peaked, and that even though Fed policymakers were expected to hike rates another 75 basis points next week, they would soon pull back. The consumer price index was 0.01% last month after being unchanged in July, while change CPI ended up 8.3% in the 12-month term. August economists followed by Reuters had forecast in monthly CPI dipping 0.1% and year-over-year rising 8.1%. Inflation is public enemy number one for the Fed, and I think this number puts pressure on them to continue, said Priya Misra, head of global rate strategy at TD Securities. We get a fairly hawkish message out of that September Fed meeting, and that's what the market is pricing in. If you look at today's massive move higher in rates, Misra said, the Fed's terminal rates could rise to the mid negative 4% range before rates start declining. She said the market before Tuesday had expected that rate to top around 3.75%, if not lower. Nomura said in a note it expects in a terminal rate of 4.50% until 4.75% by February. Fed Fund future priced in a 25% chance that the Fed will raise rates by 100 basis point BPS at the end of the Fed's two-day meeting September 20 until 21. Misra doubted the Fed would go that high, but said 75 BPS in November was possible. It really comes down to how sticky inflation remains, said Mauricio Agudelo, senior fixed income portfolio manager at Homestead Funds Advisors. It's battle that the Fed will continue to fight, and they will have to continue pressing unfortunately at the risk of breaking something. The longer inflation remains elevated, terminal rate expectation will likely slide higher, said Chip Huge, managing director of fixed income at Trios Advisory Service. The only meaningful deflationary price was gasoline, so you really had broad inflationary pressure continued to a more significant degree than what the market is expecting, he said. Okay guys, maybe that's all from me. Thank you for watching. Don't forget to like, comment, share, and subscribe. See you.